Alright, hopefully this is the last video for the chapter. We're going to start talking about treasury stock. So what is treasury stock? Treasury stock is when a company buys back their own stock. So once they issue it, remember it's out there and it can be bought and sold easily. They can buy back their own stock. So when this happens, what the stock they buy back is called treasury stock. So there's a few reasons why they might do this. One, they might want to use their shares to buy another company, so they want to have their shares. They may purchase their shares to avoid a hostile takeover of the company. They might try to reissue it to employees as a compensation, like by issuing those shares to their employees. And then also, again, it can be based off of that market price. All right, so when we have treasury stock, it's still going to be an equity type of account. So treasury stock is treated just like common stock. It's an equity that we would issue. So with treasury stock, the corporation can buy it, and then they can sell it they can resell it again out there into the market. So we're going to see treasury stock being bought and then sold, and the price that we're buying it for and selling it for is going to determine that par value or that trading value. So let's look at when we buy it. All right, so it says May 1st, Cyber Inc. purchased 1,000 shares of its own stock in the open market. They paid $11.50 per share. So we take $11.50 times 1,000 and we get $11,500. We're debiting treasury stock and we're crediting cash. So it's an equity section, but treasury stock is going to be considered a contra equity account because it reduces the equity when you debit that treasury stock account. So common stock, when we're buying common stock, we're crediting it because it's an equity account. Treasury stock is considered a contra equity account. So go back to when we thought about contra assets and contra liabilities. This is a contra equity account, so it has the opposite normal balance. So we're going to debit treasury stock to buy it, and we're paying out cash because we're buying those treasury shares. All right, if we were selling it, so say we bought 1,000 shares at $11.50. Now we're going to sell 100 of those shares. So we're going to sell 100 shares at $11.50 per share. So we're going to be getting cash because we're selling it. We're getting $11.50 cash, and we're getting rid of that treasury stock. So we're going to credit the treasury stock to clear out the amount that we're selling. All right, what if we sell it for more though? So we bought it at $11.50. Now we're going to be able to sell it for $12 per share. So our cost was $11.50 and we are now selling it for $12 per share, so a 50-cent per share profit. So we take 400 shares, and that 50 cents times 400 shares is going to be the amount that goes into that paid in capital for treasury stock. So we're going to be debiting cash for the total amount we're receiving, which is $12 per share times 400. So $4,800 is how much we're selling it for. The cost of it was $11.50 per share. So that's what comes out of treasury stock. So whatever you buy it for goes into treasury stock. The amount you buy it for is what has to come out of treasury stock. Any difference goes into that paid in capital account. All right, what if we bought it for $11.50 per share, but now we're selling it for $10 a share? So we're taking basically a loss on it, right? So that's going to come out of retained earnings. So we're going to debit treasury stock for the amount that we're receiving, which is $10 per share times 500 shares. So we're getting $5,000 cash. And then we're going to credit treasury stock for the amount that we paid for it. So we have 500 shares times $11.50. So we paid $57.50 for those shares. So that's the amount that comes out of that treasury stock common. This time though, instead of putting money into paid in capital treasury stock, we're going to take it out. You can only take out the amount that you've put into it. So we have to look at that T account, or the balance that's in what's in paid in capital for treasury stock. Once we know the balance, then we can use that amount to reduce how much we had to pull out of retained earnings to make up the difference. So we bought it at a cost of $57.50. We're selling it for $5,000. We have a difference of $750. So whatever's in paid in capital treasury stock comes off first. So that's $200. The difference between that $750 and $200 is $550. That's the amount that is going to be able to, that's the amount that's going to come out of retained earnings. So we would debit retained earnings because it has to come from somewhere. And if there's not enough in paid in capital, that means we're taking a hit on the retained earnings. So this is one where it's kind of like, well, why would we be selling it for less than we paid for it? And there needs to typically be a legitimate reason why we would do that. All right. Last, let's look at the statement of retained earnings and how it looks. So when we look at this, we're looking at retained earnings. And again, remember, that's where we're holding all of our earnings the company has had. So our net income goes into that. If we have losses, it reduces our retained earnings. And if we pay out dividends, it can reduce our retained earnings. So a lot of states are going to have minimum amounts they want you to keep in that retained earnings. So that would determine, you have to keep a certain amount there, and anything above that you could pay out in dividends, but you're required to keep a minimum amount there. So that would be like a legal restriction. There could also be a contractual restriction where you signed a loan saying, hey, you know what, I'm required to keep retained earnings at this amount. So that's where we talk about restricted. So it can be a legal restriction because the states say you have to have so much in there, or it could be a contractual restriction. We also could sometimes see prior period adjustments in that statement of retained earnings. When we look at that, we see that, if we made a mistake. So this one, they said that the cost of land was incorrectly expensed. So we had an expense that came out incorrectly. So we have to fix that now. And we can just see that our retained earnings is the beginning amount plus any adjustments or minus any adjustments. And then we add net income, we subtract out any cash dividends, and we get our ending retained earnings. So the statement of retained earnings is very similar to what we've seen before when we looked at the statement of stockholders' equity, or when we looked at the statement of owner's equity. So this just kind of shows us the beginning, an example of Apple, statement of stockholders' equity, and it's showing us their beginning, their net income, if they issued any additional stock, if they bought back any stock, and if they paid out any dividends, and that gives them their ending balance. So it's a little more inclusive than the statement of retained earnings. All right. Sometimes companies are going to give their either sometimes the employees or others the option to buy stock at a fixed price that's over a period of time. So they might be able to buy, the example they give here is the option purchase price is $30 per share. The market price is $75 per share. So the options are given to employees to motivate them to, number one, make sure that they're focusing on how the company is doing and doing their job and doing it efficiently and well. And hopefully by doing this, they're keeping them in the company. So a stock option is kind of like having an investment with no risk. All right, we go into the global view, which you guys can read on your own. And then I want to look at the ratios that go along with this chapter. So the first one is the earnings per share. So the income statement reports earnings per share. It's also abbreviated sometimes as EPS or net income per share. So it's basically telling you this is the amount of income that is generated based on the number of shares that are outstanding. So if we look here, we can see that the basic earnings per share is taking net income minus preferred dividends divided by the weighted average of common shares outstanding. So we have to know how many shares are outstanding to be able to do this one. The next one is the price earnings ratio. The price earnings ratio is going to show you the market value for the price of the per share divided by the earnings per share. So once you calculate earnings per share, you just take that answer and bring it into this ratio. So it's going to help us look at expected future cash values. So we're calculating by having the market price, which will have to be provided to you. That's not something you guys are going to have to look up. They would have to provide market price to you to be able to calculate that. Price earnings ratio is one that it can kind of vary across different companies depending on what their expected future earnings may be. All right, our next one is the dividend yield. Dividend yield is calculated by taking our annual cash dividends per share divided by market value per share. Investors are typically going to buy shares of the company hoping that they're going to receive a return from either a cash dividend or a stock price increase. So stocks that pay large dividends on a regular basis are called income stocks, and they're attractive to investors who want recurring cash flows from their investments. Sometimes some stocks might pay little or no dividends, but that might be attractive to other investors because they expect that the stock price is going to increase. Because remember, we said if companies don't typically pay dividends, their stock price increases. Amazon's a prime example. Amazon does not pay dividends, and if you looked at their stock price, you can see that it's significantly higher than most shares of stock out there. All right, so one way that we can help identify whether a stock is an income stock, which is the ones that pay large dividends, or a growth stock, which is the ones that are paying little dividends, is to look at the dividend yield. So that's why this one will be important. All right, our next one is the book value per share. Book value per share, we are going to be looking at the common stock again. So this is going to show us the amount of stockholders' equity that applies to our common shares on a per share basis. We calculate it as stockholders' equity from the common shares. So we're looking for just the common stockholders' equity. If we have preferred equity, we would subtract that out, and we divide that by the number of common shares outstanding. The other one is going to be book value for preferred shares, and it's going to be looking just at the preferred equity and then dividing it by the preferred shares. So we have one book value per common share, which only looks at common equity, and book value for preferred shares only looks at preferred shares. All right, so I know chapter 13 was a long one. I encourage you to watch the need to know videos to make sure that you're following through and understanding those examples before trying to practice. They really do help with the understanding, so that's why I encourage it. Also, you could review the PowerPoint individually instead of in the video, and you also have a preview video for the chapter that I hope you have already watched. All right, thank you and good luck with chapter 13.